You are listening to Keystone's Stock Talk Show, episode 295.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week as we record on Canada's Election Day. Aaron kicks off the festivities with his thoughts on the productivity crisis in Canada. I kick off our Your Stock Our Take segment with a review of an electrical grid modernization company, Tantalus Systems Holdings Inc., symbol GRID or GRID on the TSX. We interviewed management last week in Vegas and report on our findings. In that vein, Brennan reports back on DIRTT Environmental Solutions Limited, DRT, on the TSX, the second of the 22 companies we grilled last week in Vegas. DIRTT is profitable again, reducing debt, and looking to grow. Brennan lets you know if they may offer an opportunity. Last and not least, Brett answers a viewer question on Celestica, symbol CLS, on the TSX and New York Stock Exchanges, which provides electrical manufacturing services. The stock is up 100% over the past year in a weak market now. And after reporting a solid growth quarter, Brett lets you know if the growth can continue. All right, let's get to the show. I welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. I also wanted to just pass along our condolences in connection with the vehicle ramming attack that took place at the Lapu Lapu Day Festival, public celebration of Filipino heritage in Vancouver. Terrible crisis. Left 11 people dead at the time we're recording this, and at least 24 more injured. Our hearts go out to anybody that was affected by that, the victims, the families. Just a terrible incident, making it I think it is the deadliest attack in Vancouver's history. So certainly our heart goes out to anybody who was involved or impacted on that.
Yeah, it's incredibly tragic, painful event. And it was actually just that day we were out with friends, one of whom is a first generation immigrant from the Philippines. And she was talking to me about the Lapu Lapu event and just what it was about and how many people would be attending that. So, I mean, I absolutely couldn't believe it when I heard about what had happened that night.
Yeah, we have relatives that are in the Filipino community, and my mom was reaching out to them as soon as she heard the incident because it's an event that they were potentially looking at to attend. Thankfully, there was no impact on them, but again, impact on so many people. And it really rocked the Vancouver community when that happened over the weekend. So Terrible event. And we'll move on from that. Myself and Brennan just got back from a conference in Las Vegas. Like we said, we interviewed 22 companies. The event we've been at for 8 to 10 years plus. I think this was what I'd say the best event in that that event's history. Got together a really high quality list of microcap companies. To have 100 companies there and for us to interview, and loosely 22 are meeting enough of a criteria for us to sit down and interview them. That makes it a good conference. We were at a conference, a larger one called the Roth Conference, mid, small, and even some large cap companies. And there's about 550 there in LA just a month and a half ago. And we had about 25 interviews there. So, the high quality microcaps at this conference, I'll give the organizers some kudos for organizing that event. And we had some good sit downs, about 4 companies that we currently have in coverage, sat down, chatted with them, just asked a few questions, and then doing some discovery research on a number of new names, and potentially maybe we'll have a recommendation coming out of that research as well.
So Ryan,
good event.
Just on the topic of that, I just want to give people an idea of kind of what the pipeline or the funnel looks like. So you've got how many companies in total are attending the conference?
100. Yeah.
100, right? And so we look at essentially every one of those. We do our research on every one of those, and then we request meetings with the companies that pass our initial criteria and screens. And that would be how many companies?
Yeah, there was 22, and then we
22.
literally speed date management, right? We sit there and book them. One of the days we had 7 or 8, the other day 14, 15 meetings, and we just go back to back to back, 30-minute meetings. We prepped our questions in advance, sit down. We like looking at, and we always look at the numbers behind the company, but like we say, when we talk to these management teams, you want to talk to the intellectual capital behind these companies. That's who you're placing your money with or investing with. It's nice to get to know them. Some of these companies' management teams we've interviewed over years, if not some cases decades. I think some of them were saying, and some will never get into coverage. Some will never be a recommendation, but we continue to interview them, and then some do. We had a company, and I've told the story many times, where 4 years of interviewing them 2 or 3 times a year at events, and then they hit what we call an earnings inflection point. Boom, made the recommendation. That was a company called Vital Hub. They were originally scheduled to be at this event, but had to pull out, I believe. But no, the company then, that was November of 2023. So not long ago, trading at $3.20 in that range. Today it trades at around $10. 4 years of interviews paid off in a recommendation there. And that's what we do. And sometimes it takes one interview and the company's already at that inflection point. And there was a few companies that were, close to meeting most of our criteria right now.
Mm-hmm. Yeah, I thought it was a really good event. It was nice. Like Ryan said, there were 4 companies in coverage as well. Like, it was nice. I've got like an update report ready to basically go out to clients, but I just wanted to sit down and kind of go over my model with them. So I was like updating my model in real time with management.
Yeah, you can always get a little clarifications that may change that. And, we actually, I remember that meeting, we did get a clarification that actually increased.
Yeah, exactly. Increased our price
EPS
target.
estimate. Yeah.
Exactly. And yeah, just overall, I thought it was just a great event. It was really cool this time too, where rather than it just being in like one big hall with just tables set out, it was actually like each company had their own booth where the meetings would take place at the booth, kind of behind like a little table. So it was kind of nice. It wasn't as noisy and as loud as other years. So, like when we went to the event in the past, there's been like some soft talkers potentially as
low
like,
talkers.
some low talkers. Yes.
We're in the room and
it's hard to hear them. It's hard to hear them. And you really want to ask, meaningful questions and get meaningful answers. But, when you can't hear the CEO that's sitting across the table because you got, 10 people that are basically yelling right behind you, also have in their other meetings.
Yeah, well, you can imagine like 500 to 1,000 people in a huge room. The sound is reverberating everywhere, and you get. I mean, we have some that we've interviewed many times in the past, and we know that the CEO, like we call them low talkers. That's what they are, and we're literally leaning in as far as possible. And at some point, you just start being like, and it makes it like, well, we're gonna have to do this in another setting if we really need to, but. Yeah, no, this was a little more intimate, same amount of companies, but like booths, cordoning off all the, now you could hear a murmur around, but not like somebody screaming from the other booth in your ear. So that was good. It was a good setup. But I mean, if it was that setup in poor companies, not worth going, but it was a good setup and good level of company. So that was good to see.
Definitely.
All right. We got a poll question, right? Talked about generally your overall feelings on the market after Liberation Day, post Liberation Day. Has there been any change? We were basically asking. Brett, you've got that question.
Yeah. So it's been Trump's current term if you're just ranking by presidents, because we all know presidents just dictate the stock market. Like they like to say when it's good, but when it's bad, they have nothing to do with it. But Trump's current term has been one of the worst terms if you're quantifying it by that metric, really, since the S&P has really been a thing. It's about the same as, I think, George W. Bush's term. But it obviously doesn't mean too much. But it's really all to do with Liberation Day. VIX has really exploded. We've seen bond markets having massive volatility as well. The stock market really be extremely volatile as well. Being a bear market for, I think, like 12 hours, it was one day for the S&P, and then now we're back above correction territory. So the question is, how do you expect S&P 500 to perform in 2025? 21% of our viewers said the S&P 500 will return greater than 10%. 26% said between 0 and 10%. 38%, so the biggest amount, between negative 10% and 0%. And then 15% say less than negative 10%. So it's skewed a bit towards lower returns, but it's pretty even across the board, I would say.
The opinion is pretty even. And yeah, there was definitely bear market territory. And then we were told it was a good time to buy, right? And then suddenly the market surged. There is some, volatility is the order of the day right now. Hopefully it's calming down to a degree, but we're going to continue, I think, to see some volatility. There's going to be overall some strange numbers coming up. Like one of the things when we were interviewing companies, I'm going on a tangent here, sorry, away from the poll, but I just recall one of the companies was hit for about 2 days with tariffs, and they paid $7,000 in tariffs. We got these anecdotal stories of kind of holding off or buying inventory ahead of. So I think you're going to see some strange couple of quarters where some companies have either bought inventory as stock, as buffer stock, or companies are holding off on making CapEx investments. It's going to be strange, but that's going to lead to volatility. And I would side on the side in that poll question, because of the volatility, probably, weaker markets. I mean, you've seen that this year.
We never like to predict. I mean, it's a fun poll question. There's so many, it's such a complex mechanism, I'll say, but it's really more than just a mechanism. The global economy, it's really like an evolving organic entity, right? It's so complex that then to start to make predictions, there's just so many moving parts and so many changing relationships that it's difficult to make any type of specific prediction. But one thing that I will say is that right now it seems like the market is trading largely off of what Trump says and does in terms of, is there going to be a tariff announcement? Is he going to back down? But what we're going to start to see here over the upcoming months and couple of quarters is the actual economic impact of what's going on. And I think that once we start to see the economic impact, that's when the market is going to start to trade off of that, which means it's not as easily controlled by just simmering down the rhetoric and then that resulting in simmering down the market. So for example, the GDP now forecast in the US is for a contraction of negative 2.5% for the US economy in Q1. It's indisputable that there's been a massive amount of uncertainty injected into the global economy, and that has caused a lot of businesses to delay investment. So as we see this start to impact the economy, that's where I really think the danger of more volatility could occur. That said, it is, again, a very complex situation, and we can make our predictions in terms of where the economy is going to sit a couple of quarters from now. But those predictions could be way off. So the best thing to do is to invest intelligently in companies that are well positioned to survive and thrive in a range of different economic scenarios, and just make sure that you're in profitable companies in solid growth markets. But in terms of just the short-term volatility, that's often unavoidable, and also often an opportunity if you're ready to seize it.
Yeah, and there have been opportunities on those pullbacks, like quality names that have come on sale. On top of that, making a market prediction, like say buy the S&P 500 or sell the S&P 500, it is a market of stocks, not a stock market. And there are individual companies, even in this market. I mean, we recommended a company that happens to have exposure to gold. They drill for gold companies. That stock was just recommended in January. Just a volatile as all hell period since then. It's doubled in price over that period of time. Had 2 really great quarters out and likely a good quarter coming out next week. So yes, there's a negative overall market. Are there companies that are still growing? I mean, that's tremendous growth, a stock doubling in 2-3 months in a down market. So there are again, it's a market of stocks, not a stock market. So there are individual companies we can still find. So we kind of hesitate to say, oh, the markets are going to be down this year. That doesn't mean, oh God, get out of the markets. Like there are individual opportunities that we certainly want to take advantage of. Plus, when the markets are down, like Aaron was saying, it's most often a long-term opportunity in high quality companies. So you should look towards the markets. Many people look away in downturns times. And we had many clients phoning in as the markets, fever pitch of volatility over, a couple of weeks ago. And, our statement really was at that time, buy the high quality names in our portfolio. And again, it's proven out to be good in the near term. We'll see how that goes out over the course of this year. But if we see more volatility, we're going to buy more on those high quality names.
Yeah. And I'm sure I've said this quote on the podcast before, but, a quote by Peter Lynch, I'm always quoting the guy. He says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So, that's just something to hold on to while you are going through such a period of uncertainty.
Good. All right, well, let's get into the meat of it. Aaron's going to talk about, we're on election day. This is being recorded, and he's going to talk about the productivity crisis in Canada, which around election day, it's a topic that really is should be front of center. I don't know if it is. That's a problem. It should be.
Yeah, so you're right, Ryan. I did think that this was appropriate time to discuss Canada's productivity crisis. This is obviously a term that's been thrown around a lot. I actually have received several questions in the past about what this means and why it's happening, why it matters. So what this did is this motivated me to write an article, which I posted on LinkedIn about it, because I was interested in having an intelligent, well-researched answer to that question. And some of the things I discovered really kind of surprised me. So we're going to get into this, Canada's productivity crisis, how are we losing ground, why we're losing ground, and how to fix it. So first of all, why don't we just talk about what productivity is? So at its core, it measures how efficiently we turn inputs like our labor, like our time, like machinery and capital into valuable outputs. So put simply, higher productivity means that you are getting more done with the same or with fewer resources. Now, let's look at a bit of a comparison. If we looked at advanced economies, labor productivity, for example, in a manufacturing facility can exceed $100 per worker hour. But if we were to look in lower productivity economies like developing nations, this figure is a lot lower. It can be closer to $10 or less. So no matter how hard the lower productivity worker works, they're never going to be able to produce the same amount of output as the higher productivity worker. And they're not going to be able to produce the same types of outputs as well. So what is the reason for this? Well, it doesn't come down to work ethic. It doesn't come down to the lower productivity worker not working as hard. The key difference comes down to access to modern equipment, efficient systems, and skilled labor. So essentially investments that a country conducts over a period of time into making sure that their capital is modern, to making sure that they are up to date on technology, making sure that their workforce and their population are well educated and have access to the types of skills that the economy needs. So why does this matter? Well, higher productivity fuels economic growth. If you want to grow the economy, you can either add more worker hours to the economy, or you can improve productivity, so generate more with each worker hour. I think that most people would agree they would prefer not to have to increase the number of hours they work in order to make more money. They would actually just rather learn how to produce whatever output they're producing or service they're providing more efficiently and effectively, and produce higher wages and more wealth from that. But higher productivity, it means higher standard of living. It means greater investment into public services and generally higher quality of life, because the economy has the ability to invest in things like education, public works, and other forms of important infrastructure. But the reverse is also true. If you have stagnating productivity, or if you have productivity that is in decline, this can erode the standard of living. It can cause wages to be flat or decline over time. And this is essentially creates a cycle whereby if this problem persists for long enough, it becomes harder and harder to reverse it, because you have less resources to reverse it, and you need to actually make a greater investment over a longer period of time just to get back to where you were. So what does this mean for Canada, and what is Canada's productivity crisis? Well, the reality is that Canada's productivity has been in jeopardy for a significant period of time. Since 2000, Canada's labor productivity has grown at roughly only half the pace of US productivity. So if we look at a 20-year period from 2021, on average, up to 2021, US productivity growth was about 1.5% per year compared to about 0.5% per year for Canada. But this actually has gotten worse. In the 5 years leading up to 2021, this trend in Canada turned from slow, stagnating productivity to an outright decline, declining on average by 0.3% per year, compared to the US that actually made progress, increasing by 1.7 annually. Now, the United States, which was once seen as our very closest friend and ally, we're now in a situation which is looking more and more adversarial. And we're in a situation where we have to actually consider how we compete against the United States long term. Now, while we should have been considering this for many years, better late than never, but Canada's productivity in terms of what it will take to turn it around is an incredibly important ingredient to how we compete with both the United States, but just also in the global community over the upcoming years and decades. Now, if we were to look at just the last 3 years, the situation has actually got even worse. So according to StatsCan, Canada's labor productivity in the last 3 years has fallen by an average of 2.4%. And so as a result, currently, Canadian worker produces only 72% of the output of a US worker for the same amount of time. So we're only 72% as productive here in Canada. And again, the problem is not necessarily the nominal number as much as the trend is going in the negative direction. So this number was 82% going back to the year 2000. So it's gotten significantly worse since then. And it's not just the United States that we've been falling behind as well. On the global stage, the picture hasn't been looking much better. Canada's around mid-pack for advanced economies, trailing not just the United States, but also countries like France, Germany, and Australia. And we're now more closely aligned with the productivity of Italy and Spain. And in fact, only Italy out of this group has experienced a more severe relative productivity decline since the 1980s. So we are losing ground against the United States, but also against other members of the industrialized economy. So what is the cause of this? Well, we had talked before about how the difference between the high productivity worker and the low productivity worker, and the main difference being the high productivity worker had the benefit of investments being made in their economy and in their skills, their training, and their equipment. And this is really where Canada is dropping the ball, is an underinvestment in technology and infrastructure. Now, I know I said that this is topical because it's happening around the time of the election, or on the day of the election that I'm actually giving this talk. But my argument here is not that this is necessarily a failure of government, although there are policies that we can point to where the government can do much better. But it's a far broader cause than just that. This comes down to a number of different factors that go outside of government, and just comes down to the way that Canadians and Canadian businesses look at risk and look at investing. So overall, if you were to compare Canada versus the United States, this is for 2023, the investment for every dollar that US companies invested into machinery and equipment for their workers, Canadian companies only invested 41 cents. So relatively 41% of the investment. And when we look at intellectual property products like technology, that number is even worse. Canadian workers only got 30 cents for every dollar that the American workers got in terms of investment. And again, this is the same when we compare ourselves to other developed countries. So compared to the OECD average, our total R&D investing as a share of GDP is well under the average, 1.9% compared to 2.7% for the OECD average and 3.5% for the United States. So in 2021, US firms in advanced technology sectors spent 103 times more on R&D than their Canadian counterparts. So this is in spite of the fact that the US is about 12 times the size. So when we adjust for size, that means that Canadian businesses are investing only about 11% of US level R&D. Now, this is a big problem. And the question is, what is causing this? So as I had mentioned before, there are a number of issues. We can look to policy, but I want to look beyond that. I want to look to something that is more universal across Canada. And that's that Canadians tend to have culturally a more risk-averse nature relative, at least to Americans. So unlike the United States, where bold ventures and high-stakes innovation are often encouraged, even celebrated, Canadian firms tend to prioritize stability, predictability, and incremental change. So there's growing evidence that this is the case, and I've actually referenced in my article several studies on it. A couple of them include the Conference Board of Canada. They did a study, this was in 2024, describing the country as having a risk-averse innovation culture and assigning it low marks on critical technology adoption. There is an article in Policy Options. This is a little bit older, but it highlighted how Canadians' risk aversion correlates with the lower R&D spending and investment, and that Canadian companies have a tendency to cling to older techniques. As well, Deloitte put out a report surveying 1,200 Canadian business leaders, and they found that only 11% of the companies could be considered courageous, meaning willing to embrace significant change or take on calculated risks. So this is obviously an issue that anybody in the business community in Canada has probably discovered themselves. Now, I can think of my own example in the investment finance space, in the equity research space. This is related to how we get information on public companies. So the government database that provides this information is called CDAR. The equivalent in the United States is called EDGAR. So ever since I started in investment research, which was over 20 years ago, EDGAR in the United States has been a very modern system that provides multiple ways of accessing data, both in PDF or HTML, or also programmatically through an API so that you can connect it to computer systems. Now, you compare that to Canada and the CDAR system, and it always, for 20 years of working in equity research, been the same archaic system that didn't provide any type of digital access to financial data that was widespread across the companies. Rather, it was just one way of accessing data, which was through PDF, and that makes it very difficult to do anything. Well, just a couple of years ago, they upgraded that system, and I was a little bit excited of what they could actually do with it. But even after 20 years, they upgraded it, and it really is just as archaic and hard to use, perhaps even more so than it was. So that's just one example in my industry of how Canada has just not kept pace with making sure that they're at the cutting edge when it comes to technology and innovation. But many people that have experience dealing with US businesses versus Canadian businesses will often report that in the United States, there is more of a tendency to be competitive and to make bold decisions and to embrace innovation and embrace calculated risk and just make decisions. Whereas in Canada, the tendency is more towards risk aversion and taking a long time to mull over decisions and then ultimately not move towards the direction of calculated risk. So how do we reverse this trend? What can businesses do? Well, to the extent that culture is the issue, and again, there are many things that could be attributed to this issue. It's a very complex situation. It's not just, we can't simplify it by just saying that it's one thing. But to the extent that culture is a contributing factor, the power to change this is within all of us. So what can businesses do? Well, the first thing a business should do is make an effort to benchmark their productivity levels and investment relative to industry and global standards. And to the extent that there is a significant gap, to evaluate why that gap exists and then plan incremental improvements towards reducing that gap. That doesn't mean knee-jerk, large movements, large reactionary movements right away, but rather incremental movements that embrace the idea of calculated risk, and also provide a learning experience in terms of how to become a more risk forward or calculated risk forward business. And then also just fostering a culture that supports innovation and encourages the sharing of new ideas. And then, of course, individuals also have a part that includes continuous learning, taking the initiative to upskill through courses and certifications and other types of resources. And then looking for opportunities to implement new tools and technologies such as AI into your own existing workflows. Also encouraging other people in your organization that are trying to do that. So in conclusion, the productivity crisis that we hear about, it's not just an economic stat. This is a real risk that does threaten the nation's future prosperity and way of life. The root causes, again, are very complex, but no country should expect to maintain strong productivity while underinvesting the way that Canada has. Now, to the extent that culture plays a role, we can all contribute to that solution. And everybody has a part to that solution. It's not just the government, it's also private business, and it's also individuals. So that concludes my article. If any of you have any comments.
Awesome.
Yeah.
One thing that I would like to say is that, we ended up putting out a telecommunications special report earlier this year. And I ended up, when I was doing my, kind of broad industry overview, I came across a nice research report by PwC that's called Driving Canada's Productivity, the Impact of the Telecom Sector and its Role in Improving Productivity. And when I was reading it here, it was basically kind of talking about, like, I'll kind of quote some of the conclusion here. It says, the impact of an unhealthy telecom sector where telecoms lack adequate free cash flow to fund investment in connectivity impacts not only the industry itself, but also the broader economic productivity of the country. When telecoms cannot advance connectivity, the quality and availability of digital infrastructure becomes limited and decreases relative to other countries. They go on to, highlight some of the things here. They say, in the future, the Canadian telecom sector will continue to contribute significantly to Canadian GDP and jobs, positively impact revenues across industries, yada, yada. However, recent trends could potentially reduce the capacity of the sector to make ongoing investments in network infrastructure, including, interest rate increases are raising debt costs, as well as, just this is limiting the available funds for investment. So, if anyone's interested, again, that's called Driving Canada's Productivity, the Impact of the Telecom Sector and its Role in Improving Productivity. Thought it was a pretty good research report that they put together. But yeah, it just shows, just the free cash flow from, our telecoms has been dwindling over the past few years, kind of leading to some of this stagnation in investment as well.
Yeah. One of the things that I believe that hurts this country is the way some of our biggest industries are structured and have been protected, and that would include the telcos, to like dovetail off of that. The airlines and the banks, they're oligopolies. They don't have the incentives to innovate. They're insulated from competition, and that would drive a lot of profitability to me. I mean, you just, I you have, like, we fly all the time. We have two airlines that we can really choose from, and 90% of the time they're hideous, but you have no choice to go anywhere else. The banks, they still use old systems. Like, it's hard to even transfer money between like a brokerage account and your main just checking account. Like the systems that are in place, if they faced significant more competition, those things have to be innovated. But in this case, I think that leads to less innovation, a lack of profitability. I would agree with Aaron that risk aversion generally in our culture is an issue.
Mm-hmm.
And there is, a declining Canadian dollar over time makes capital equipment, importing it, more expensive, thereby discouraging investment. And that's with a lower dollar, particularly when we're butting up against the US, which, it costs them less money to buy an NVIDIA chip or, things that can create innovation, particularly in tech. And then the tax structure, higher capital gains. They were just on the table for the Liberals. Now they've been pulled back. But why set up a tech company in Canada where you can innovate and become more productive? Where you can, it's harder to attract the best talent in those companies because of a poor tax structure. Now, there is some states in the U.S. where the capital gains rate is actually higher, right? But then there's 50 states, so there's some that are significantly lower than the low end that you can pay in Canada. So you can set up shop there, and it gives them a tax advantage. And we don't seem to be completely aware of that. I mean, we are aware, but we just poo-poo it. The governments, I don't think they really. If you really want to be a leader in tech, set it up so you have a tax advantage situation. It wouldn't have to be a crazy low tax rate. Just make it, you're in competition with the US. And then to our industries, those oligopes, open up some competition. I'm not sure what we're afraid at. Like I get in the banking industry, we need the regulation, but just make sure everybody that comes in is regulated as well to the degree that the banks here are. So anyways, that's my soapbox on it. But it creates good discussion.
I'll just add on your capital gains. The interesting difference between Canada and the US for our capital gains is they have short-term capital gains, which are taxed at a higher rate as well.
True.
So they actually push you towards, if you want to get that taxable benefit, to hold over a year. So,
which I think is great, to be honest. The structure
aligns with us, obviously.
Yeah, it certainly aligns with us. Like if you're looking to, and there were some proposals made by candidates in this election to roll over Canadian companies in if you made a gain in TSX listed XYZ and then you roll that over into TXS listed ABC, there's no capital gain, and that can compound over time. I think that's a great way to keep you invested in Canadian companies as well. You don't do that just to stay in a Canadian company. You got to find the best companies to invest in. But if it happens to align, I think it's great. Maybe that will come to fruition. We'll see what goes on. There's people voting today.
Yeah,
so we'll see.
And that's the thing. Like I brought that up to a bunch of people, that they're planning on getting rid of the cap gains if you're rolling it over into another, TSX listed or Canadian company. And I got like a lot of people like that would say, oh, but you're taxed eventually. Well, yes, you are, but it's the tax-free compounding that is, growing. Like people need to understand the.
Well, there's also just a lack of education on anything to do with tax, and then our tax system too is sometimes more complicated in the U.S. We have the inclusion rate on the capital gains, and people think you're taxed at 50%. It's actually just the include. Like I go into a forum on taxes in Canada versus the US, and it's just the lack of knowledge. And I sympathize, because it can be the gross up on dividends. People are like, what the hell is that? And it's just, can we not simplify things? We can, but they seem to try to make it complicated. And it's complicated just for the average person. And it makes it hard. Like, why would I invest? They don't know the difference between getting interest income and dividend income. And that should be, you should know that the dividend income is treated far better, but it's just, again, it's because it's complicated. But anyways, all right. I think that was good discussion there. Did anybody have anything else we want to go through, or should I move on?
Move on.
I think we'll move on. Mercifully, is that what you're saying?
Yep.
All right. So the company I'm going to talk about today is a company we just interviewed last week at the Planet Microcap event in Las Vegas. Tantalus Systems Holding, symbol GRID or GRID on the TSX, trades just over $2, $106 million market cap. But what does Tantalus do? They offer smart grid solutions. They provide a range of smart grid solutions, including intelligent connected devices, communications networks, data management systems, and enterprise applications and analytics, connected devices and infrastructure. That's one area of their business. This segment includes computing modules for devices like meters, sensors, and street lighting, as well as automation equipment and communication infrastructure for industrial IoT network. Another segment, utility software applications and services. This segment offers software licenses, hosting services, software as a service, professional services like project management, deployment, and maintenance. The company is focused on grid modernization. Tantalus solutions are designed to help utilities transform their aging one-way grids into multi-directional grids, making them more resilient and efficient. Supporting utilities, Tantalus has over 300 utilities across North America. You can see here, and the Caribbean with a high customer retention rate. Summarizing here, services are now around 320 utilities. The company has deployed 3.5 million connected devices in its history. 2024 revenues were 44 million US. About 35% of that was software and services, higher margin business. Just over 12 million US in annual recurring revenues and 1.3 million in adjusted EBITDA in the last year. With a capital raise this past year, the company believes it is capitalized to commercialize its next growth phase, and that is this product, the TrueSense Gateway, a multi-purpose device designed for use in existing ANSI meter sockets. It allows, so your existing socket on your house, it allows utilities to modernize their distribution grids by providing a secure communication path, advanced power quality measurements, and support for broadband initiatives, all without requiring a complete replacement of the existing metering infrastructure. Tantalus believes that the company's TrueSense Gateway provides a compelling growth catalyst, 150 million potential revenue opportunity from their advisory committee, 8 to 9 companies that are looking at it right now, 350 million approximate revenue opportunity in its qualified pipeline, 10 billion total addressable market. That's a large market. They would get a slice of that, they hope, over time. 10 to 15% growth rate of Tantalus's existing business. Multiple utilities have now been demoing the TrueSense for nearly 6 months. First commercial TrueSense orders are expected anytime, which would validate the product's business case. But again, until they are signed, it does remain speculative. So let's take a look at the company's historical and annual revenue and gross profit figures. Revenues have fluctuated, but generally over the past 8 years have gone higher. Similar in terms of operational profit and income. We have yet to see an inflection point in terms of revenues, a true inflect up and profitability, but the move higher over the past year, as we can see, is encouraging. And we'll look at those numbers, particularly where we saw growth in Q4. The Q4 numbers, revenues increased 21% to 12.6 million, setting a new milestone for revenue generated in a quarter for the company. Revenue from utility software applications and services increased by 36%, while revenue from connected devices and infrastructure increased 14%. The increase in revenue were a result of adding new utility customers and continuing to expand deployments with existing accounts. Recurring revenue as a percentage of total revenue was constant at 24% of total revenue in the quarter. Gross profit margin increased 100 basis points, 52.4% as a result of increased contributions from the software segment, higher margin there compared to the prior year period. Income for the period was about 1 cent per share. That decreased compared to last year's income of 2.3 million, but that was a recovery on the contingent consideration from an acquisition of a company called, well, it was doing business as Congruitive in the prior year period. Adjusted EBITDA came in at 1.4 million compared to 348,000. So good growth there compared to the prior year. And cash flow was positive for the quarter as well, 3.3 million compared to about 131,000. Let's look at the balance sheet here quickly. 13.2 million in cash after a financing over the last year, debt of about 10.6 million, lease obligations of 2.2. Net cash, if we remove the lease obligations, is about 2.6 million. So the balance sheet is solid. Valuations here, based on actual 2024 EBITDA, trades around 55 times, 26 times expected next year, about 12 times if we take a street consensus there, 2026. The street is split on how fast the profit will inflect and how aggressive that inflection will be. Most are looking at a significant jump in 2026. But again, we caution the orders still have to come in. conclusion, Tantalus is an interesting company. We like the space, having profited tremendously from our last electrification recommendation, which was Hammond Power. The difference at this stage in relation to Hammond Power, when we bought Hammond, we were able to buy it at about 6 to 8 times EPS with growth, a growing dividend, and no speculation on market acceptance or not to power its growth. We do see a path for TrueSense to add significant growth to Tantalus's business, but there remains risk, obviously. The trailing valuations remain high, but the company certainly has the potential to grow into them. We're monitoring the company at present as it doesn't make our criteria in terms of consistent profitability. We saw profitability in the last quarter, which is a great sign. Company reports its first quarter earnings on May 7th. We'll be on the call and we'll look for management, their indications of where the future of the company goes and how that quarter comes out. We expect that to be a softer quarter compared to Q4. And at this point, no positions in the company, but we're monitoring it closely. We like the business.
Yeah. I think it's like a sexy space to potentially partake, but again, it is like a little early. And when we spoke with Peter, he was indicating that, the qualified pipeline, they had about 9 utilities that have helped them, build the TrueSense. And then there's about a second bucket of like 35 utilities that they'd like to tap into. And, he was saying that when they issued their 2024 results in March of 2025, they had about 28 utilities, which had like started pilot projects with them or project trials. So, it is interesting to see where they go. Obviously, they want to grow that. When we spoke with Peter, he was, basically saying that if they could offer the TrueSense for free and just get it out in the field,
yeah,
they
that was
would.
my suggestion, because you get
Yes.
a ton of recurring software, high margin
Exactly.
revenue off that. It
And so
is
what was
funny
his-
because
Did he have
Sorry.
rationale for not doing that?
well, I mean, it is a significant cost to get it. I mean, they have competition too, but
They're
now
ahead
there
of
is some disruptors coming in, but they're using NVIDIA chips, and the chips themselves cost more than Tantalus's device, basically,
Mhm.
as we understand. So the cost plus the devices, some of the disruptors. I mean, they're a disruptor to agree as well, to a degree, for sure, in this space, but some trying to build even more advanced tech than them. The cost on them now is so prohibitively high that, I mean, they've been dealing with utilities for years, and getting approval for budgets is difficult at the best of times. When you're talking about, factors, huge factors of the cost that they are going to charge their device for, plus the devices, like the disruptors of their own technologies, devices, they're overbuilt. Like, they can't even see use cases for what the additional power in these devices, computing power, would actually do. So, I mean, again, it's in their interest to do that, but I've seen some independent third parties also say the same thing. So, I mean, it is interesting.
Very.
We need modernization of the grid. We believe that. It's one of the reasons why we were, involved with Hammond Power. I mean, I at the event, I said, Hammond Power has gotten into the power conditioning. There is software for power conditioning. I said, maybe Hammond will look at you. I mean, again, I'm kidding in terms of putting those two together right now, but Hammond certainly has the free cash flow to bite off $100 million. I don't think they'd want to sell at their $100 million market cap. You need a significant premium, But again, it's an interesting company. They're still they need to get through the testing phase, get those products out there, sell that service, and get the recurring revenue coming in from that. It may happen. If you're an investor who likes to speculate that, believes in the technology, maybe there's a case to be made. Yeah. We just like when we have illustrated our case for orphan stocks, give us some proof in terms of those results. There may be more eyes on this company, so maybe when we see proof, the stock is already too high on a valuation basis. But there's often times where you get proof, there's a general market decline, and we may get a chance to buy a company like this. And we did that with a company called VitalHub, which was profitable, was proving out, getting more and more profitable, and then traded at like an all-time low in terms of valuations in a weaker market. and we were able to buy that right, at its inflection point. And we actually had the proof already there in the numbers that they could be significantly cash flow positive. For all the companies you may miss because you don't get in early enough to have the consistent profitability. Again, we've cited this so many times now. It's 90% of companies are already profitable that go up 10x in the microcap sector, small profitable companies. So, you might miss the 1 out of 10, but you're baking in a little bit more safety, and you need to have safety. It's about sometimes not losing money.
Yep.
That it is about, if you go after every story, you're not going to have a solid portfolio. You need story with underlying numbers. That's what you're looking for. They can be unicorns, but you can find them. All right, let's move on. I think, Brennan, you have another company that we interviewed at the Planet Microcap event. That's DIRTT, environmental DIRTT. Interesting name.
That is correct. DIRTT Environmental Solutions Inc., DRT on the TSX, currently trading at about $1 per share. I think it actually closed just under $1 today. Market cap about $190 million, and it doesn't pay a dividend. But they are a provider of industrialized construction for interior environments within workplace, healthcare, education, and the public sector. DIRTT offers comprehensive prefabricated modular solutions, including complete interior solutions, drywall alternative, glass partitions, casework, power, networks, floors, and more. And the company also has its design integration software, or ICE, which enables smart, precise design manufacturing. Now, Brett covered the stock in February of 2025 on the podcast when it was trading at about $1.18 per share. And this was following the company's Q3 financial results. But I thought that I would do a quick update, given we spoke with Benjamin, the CEO, in Vegas last week at the Planet Microcap conference. So if we look at the last year period, the stock is up about 46%. But since its 2019 highs over 6 years ago, the stock is down over 80%. The poor stock price performance over the long term primarily comes down to a lack of profitability, as gross margins were compressed significantly in 2022, but margins have begun to recover following Benjamin Urban becoming the company's new CEO in the summer of 2022. And since then, gross margins have increased back to where they were pre-COVID, toward the mid 30 or higher 30% range. And this is due to cost reduction measures, manufacturing efficiencies, and price increases. Plus, operating expenses have also decreased due to a reduction in salaries and office costs, as Benjamin reduced staff by approximately 30%. And as such, the company has now posted 7 consecutive quarters of positive adjusted EBITDA, posting an adjusted EBITDA margin of 8.8% in fiscal year 2024, up from about 4.4% in fiscal year 2023. Now, looking at the recent quarter of Q4 2024, ended December 31st of 2024, keep in mind all numbers here are in US dollars. Revenue decreased 4% to $49 million. And annual revenue was $174.3 million, which was in line with the company's guidance range of $165 to $175 million. Gross profit margin was down slightly to 35.9% from 37.8% for the same period last year. Net income was $4 million, or about 2 cents per share, up from about $955,000 or 0.008 cents per share in Q4 of 2023. And adjusted EBITDA for Q4 was $5.5 million, or an 11% margin, up 28% from the same period in 2023. Now, the balance sheet is in good health, with net debt and leases of about $22.7 million. But as Brett noted, this follows a rights offering, which they used to pay off a significant portion of their convertible debt. So you can see the business now has a forward net debt to EBITDA multiple of about 1.1 times if we're using their fiscal year 2025 guidance, but shares outstanding have increased from about 116 million to about 190 million shares outstanding. So, generally, overall, I would say the business is certainly trending in the right direction. Now, looking forward, the business is guiding 2025 revenue of 194 to 209 million, which would represent about 15.6% growth over 2024 at the midpoint, and adjusted EBITDA of about 18 to 25 million, which is 39.5% growth over 2024. And this would be an adjusted EBITDA margin at the midpoint of about 10.7%, or roughly 11%, we'll say. But the business is looking for both revenue growth and margin expansion in the year compared to fiscal year 2024. I will note that this 2025 guidance does not take into account potential significant impact of tariffs and does not include benefits from the new integrated channel, which is essentially the company's plan to diversify its distribution to construction contractors. And as the company is looking to expand beyond its current distribution network of furniture dealers, essentially, it is beginning to onboard construction contractors. And Benjamin says he has been making good headway on this new revenue diversification strategy and believes that in early 2026, due to adding several construction partners, it could become its own line item, as it will potentially represent over 10% of revenue coming in. So we will keep a close eye on that. And looking at the valuation, the stock trades with a forward valuation of 7.4 times enterprise value to adjusted EBITDA. So I believe the company is reasonably priced, but EBITDA margins are relatively low at about that 10%, 11% range. So I would not expect the stock to demand a significant EBITDA multiple at this point, at least. So to conclude here, DIRTT appears to be trending in the right direction, with the business turning around under the control of new CEO Benjamin Urban. Costs are down, margins are up, and the business is looking at diversifying its revenue distribution channels. The company has approximately $400 million in revenue capacity with its current facilities, and the ICE software platform allows the company to have a 10-day manufacturing lead time, which is quite impressive. The balance sheet is in decent shape with a forward net debt to EBITDA multiple of 1.1 times, although DIRTT's outstanding shares are now up to about 189 million shares outstanding. But the company did recently instate an NCIB, so they will be buying back shares. Now, management's fiscal year 2025 revenue and adjusted EBITDA guidance is promising, but there does remain some uncertainty around tariffs impacting the business, as well as the business has a higher sensitivity to macroeconomic conditions due to their industry. But I would say that at a forward valuation of about 7.4 times enterprise value to adjusted EBITDA, I believe the company is reasonably priced. But again, EBITDA margins are relatively low at about 10%. So I would not expect the stock to demand a significant EBITDA multiple at this point. But like Brett said back in February, there is a case to be made that the business offers value if they can continue to execute going forward. Now, overall, I think it's an intriguing turnaround story, and we will certainly be monitoring the business in 2025 as they execute on their guidance and work to add those construction contractors to their distribution channel. And here's the disclosure: we do not own any shares.
Great. And I think that, what you're saying on the valuation is probably pretty much spot on. Like when I look at the company as it sits right now, 10% adjusted EBITDA margin, that's a low margin business, especially because they do have some debt, not a huge amount, but they do have some. But you wouldn't expect generally a low margin business to command a high valuation or premium multiple. So it's probably appropriately valued. Now, if they're able to hit some of those growth numbers and repeat that for a couple of years, then certainly there could be some upside, but they'd still have to hit those numbers.
Yeah, get potentially closer to capacity, grow, and then maybe see some efficiencies there and increase margins. There is a general tightening of capital spending in this segment, generally just not the segment, but just construction right now. So I would be a little bit in the near term worried about the next couple of quarters. Potentially you see that ease up and, some certainty come back to the market, and then larger projects move forward. Maybe there'll be an opportunity if you see some weaker results that are more of an anomaly than anything else. And then over the long term can be a good situation to look at. We're not there yet. We continue to monitor the company.
Yeah, one thing that I just also add to that I didn't touch on, they do have a lawsuit that's currently ongoing, which could potentially be a bit of a windfall. But just something to note as well, as I'm sure people are like, you didn't mention it.
Yeah, there's
online,
up to about 50 million
correct.
there. Now, we're not sure they can actually get that capital, but they would be able to potentially, one of the things they could do is get it's from the former founder that the lawsuit is involved with. They could, they started a competing business, basically, as I understand, and they may be able to get the customers back that kind of bled over.
Yep.
That would be a significant win, even if you couldn't get the 50 million that you're potentially asking for. All right. Last but not least, as we said, we're going to have Brett look at Celestica.
Yeah, so I've actually covered this relatively recently, but it's had quite a dramatic price movement with all the tariffs. So we'll get into that a bit. But this is one of those companies which we constantly get questions about. And we have really the past, 2-3 years ever since it's really had a change of pace. So it's quite an interesting and topical company to go over and update as well. But if you're not aware, Celestica, symbol CLS, it trades on both the TSX and the New York Stock Exchange, provides electrical manufacturing services broken into two segments financially: Advanced Technology Solutions, or ATS, and Connectivity and Cloud Services, CCS. ATS includes a wide array of products and services for industrial usage to aerospace and defense. CCS is predominantly enterprise-level data communication, information processing infrastructure, including routers, switches, data center interconnects, edge solutions, servers, and storage-related products. And as well within that, they do have the hardware platform solutions, HPS, which is to do with high-speed data interconnects for AI and machine learning, and we'll get into that as well. The shares are trading at roughly $87 US. I'll be doing everything in US dollars because that's what they report in, and that's a $10 billion market cap. The shares of the stock had still a relatively strong year, but have come off the all-time high set earlier in the year. And since last coverage we had on the stock, it has come down as well. We covered that actually right around the peak. Last time I mentioned the stock traded at a significant premium relative to its historic self as well as its peers. With the price dropping, valuations will have come down as well, but we'll get into that as well in a minute. But overall, stock still very high compared to it was a year ago, but it has come off the peak, and that's similar to most other tech companies. Trump's tariff liberation day really spooked the tech industry, and they've all pretty much followed the same trend of falling quite a bit and then rebounding over the past week and a half or so. A quick look at the last quarter, Q1 25. Total revenue was up 20% to $2.65 billion, above the guided range, with CCS segment up 28% to $1.84 billion, driven by high growth in the hardware platform solutions, HPS subsegment within that, and that grew 99% to $1.03 billion. So that's your growth driver of the entire business. It's HPS. And it's that focus on AI and machine learning networking products. So it has really just benefited from that trend overall. And that really needs to be our bold thesis for Celestica as a whole, is the AI trend continuing. Because without that, they are not seeing the growth that can even remotely support a valuation at which they're currently at. The ATS segment grew at 5% year over year to $807 million. The revenue split at this time is 70-30 CCS and ATS, with HPS accounting for 39% of the total revenue. So it's actually over half the CCS now. And that CCS segment, because it includes HPS, has grown it to more and more significant share of the total revenue over the past few years. Non-GAAP gross margin came in at 10.3%. The company is a contract manufacturer, and low margins are just normal for the industry. That's what you expect. So across the board, expect low margins for anything in the space. Adjusted operating margin came in at 7.1%, an improvement from 5.9% in the previous year, and that's above the guided range of 6.8%. GAAP EPS came in at 74 cents, and adjusted EPS came in at $1.20. Both of those are above the guided range for the quarter. So overall, good quarter, beating the management's guidance. That seems to be the trend. They seem to do a bit of sandbagging. Guidance normally underdoes the actual performance, or the actual performance overdoes the guidance, however you want to look at it. So free cash flow, moving to that for a minute, is it grew 38% to $94 million from 68%, despite being negatively impacted by increased working capital of $46 million compared to the prior year's negative impact of $13.5 million. So you're seeing that as you build a business, you are going to need to take on more working capital. That's not surprising. So when you are looking at free cash flow metrics, especially, or even operating cash flow metrics, it's good to pay attention to that working capital level, because right here you see it does jump quite a bit compared to the prior year. But that is always something you need to keep an eye on because it does impact the company. So good growth overall, just despite the increased working capital still. Shifting to the balance sheet, the company has gross debt of $887 million and net debt of $584 million, resulting in a gross debt to EBITDA of 1.1 times and net debt to EBITDA of 0.7 times. The company is leveraged, but that leverage is not really a concern at this time. Their growth is supporting that level of leverage. And looking forward now, the company actually did update their guidance, shifting up annual guidance just a touch, pretty much, and as well as releasing their Q2 guidance. For Q2, they're guiding revenue of $2.575 billion to $2.725 billion. So that's $150 million range. Adjusted operating margin, I should say, of 7.2%, and adjusted EPS of $1.17 to $1.27. So overall, good guidance. It's looking at sequential growth. For the year, the company raised their revenue outlook to $10.85 billion from $10.7 billion, adjusted operating margin to 7.2 from 6.9, and adjusted EPS to $5 from $4.75, while keeping the free cash flow the same at $350 million. Guidance increase is good, especially given that weak tech environment, which I mentioned before, from the U.S. trade war. The company's guidance assumes no material impact from tariffs or trade restrictions, which as we have seen, can change quite quick. So that could change, but that's what they're basing their estimates on. And any tariffs, so at this time, are just passed through to customers. So less of a direct impact to Celestica. But what I would be concerned about is the indirect impact if we do see a massive drop in demand, as well as just within the space, and as well as just a general macroeconomic condition. It would likely impair the company's growth. As if that does occur, you'd likely see a bit of a pullback from the hyperscalers. But at this time, we haven't seen that. So far, they've all been reaffirming their data center spend for the year, even though there has been quite a bit of speculation and then rumors, and they go, oh no, our spend is the same. I think you've seen that from Microsoft and Amazon, both having that scenario play out so far. I could be missing some as well. But moving to valuations, based on management's guidance, the company trades at a forward adjusted P of 17.4 times, a price to free cash flow of 28.6 times. Still high valuation compared to historic levels. But of course, the company has seen significantly higher growth over the past few years now with AI boom compared to what they used to be seeing, which was really marginal growth. So overall, the company is much more appealing than when I last covered it, just because that valuation has come down quite a bit. I didn't have it up in the last time, but I think the forward adjusted P last time I covered it was 27.4 times. It was a full 10x multiple less, just to give you an idea. So it's much better valuation. The growth is still powered by HPS, which is not a surprise, and that really isn't expected to change. Still a good balance sheet. There is a bit higher macro risk with tariffs and just a general slowdown, but the price drop has, I would say, offset that fairly. Unless we do see a significant pullback in AI spend, which of course that is really the risk with the company. The valuation is much more reasonable. Was trading a premium before, so I'd really more put it at a fair value right now instead of a premium valuation. If you do see continued strong AI growth for the next, let's say, year to 2 years, you'll likely see the stock perform well. But then on the flip side, if you end up seeing the hyperscalers start to pull back on their capital expenditure for AI data centers in general, you'll likely see downside. That's really your external trade-off at this point, and that's why I would rate it really around fair value. The valuation is an extreme or a screaming fire sale at this time. So for now, we will continue to monitor the stock. And for disclosure, we do not have any position in the company or any relationship with it.
Yeah, I think fair value is a good call. I think that's about where it is right now. It's balanced between, I mean, if you knew that that the trend in its growth market was going to last for 5-10 years, then you'd be buying Celestica right now. That's where you just don't know. There probably is a 10-year plus growth trend. Is it going to be like this though? I'm not sure. Maybe it's not going to be like that. So, there may be a more opportune time to buy, but it can be fluctuative in terms of its earnings. It certainly performed well over the past year though. However, any further thoughts?
I would say that's really indicative of the industry as a whole too. It's not just picking on Celestica. And I think that's what a lot of people aren't really accounting for, those Super Bowls of companies like this. It's a cyclical environment. You're going to have spending pull back at some point, whether it's a year from now or 5 years from now. That's the big question. And right now it does seem strong, but it can change quite
Yeah,
quick, and you will see valuations plummet in that case.
and that's
people,
where you need to be aware that
people
valuations
also have
cannot
to
be premium.
recognize the difference. Like when they're looking at a technology company, there's a big difference between a SaaS software company that's generating sticky recurring revenues. They don't have to go out and re-sign their client. They just have to provide a service so their client doesn't cancel on them, right? Where there's more friction when you're doing these big jobs and then you have to renew them with other big jobs. And so you're generally going to get a lower valuation. Then plus, again, there's the lower margin. You would expect a lower valuation from that. But, sometimes when you associate a company with a very hyped field like AI, then that moves it in the other direction.
Yeah.
One thing I will say on AI that I have heard a little bit of, recently, just I would say the last couple of months, is a lot of companies finding that, they went through a period where they've spent a lot on AI and everybody's rushing to spend on AI. But now in many cases, companies are kind of questioning, well, where was the actual ROI, return on investment that we got from that? And they're really kind of looking at that more and taking perhaps in some cases a slower pace to try and determine whether or not it is actually worth it, or if they're just, really interesting tools that they're adding, but it's not really making the businesses better. So in some cases, it's making the businesses phenomenally better. But again, you can't just spend and invest blindly. It needs to be deliberately and based on research.
Yeah, I think there was a period too, fear of missing out. You gotta,
Mhm.
your neighbor company is doing that. Oh God, I gotta be in. And there's certainly some amazing use cases, but there's nothing like a little time of uncertainty to have people start looking at, wait a minute, is there an actual ROE on this? And that's what we're going through now. And then people start to say, I don't, spending pulls back. And I think that more than anything is what's going to come out of this tariff period, the uncertainty and the spending pullback. It's hard to spend when things are uncertain. So you're going to see a pullback.
And
particularly in some areas.
any technology, any theme, there's going to be fluctuation in the spending and the interest. Like look at the internet boom and bust, the .com bubble, right?
Yeah.
Obviously, the internet was a very real technology. All the stories that were being spoken about at the time were true, but that didn't justify infinite valuations for companies that had .com in their name. And we saw how that played out, but then the industry rebounded over time, and we have a lot of highly profitable companies that have come out of it.
Yeah. Brennan loved pets.com. He was all over it.
Well, it was a new
it's true.
normal. So, I just, this
Get
new
in.
normal with .com behind all their names. New normal.
Brennan was like 6.
It was literally just a
Pets.com
website with pictures of pets, and it got $100 billion valuation.
I think $2 billion. It's crazy.
Yeah, I can't remember the exact story from the Intelligent Investor, but like this would have been one of the newer versions of the Intelligent Investor with I think Warren Buffett wrote kind of like the preface to it. But he ended up using, I can't remember the exact name, but it was some stock where, yeah, exactly. They put .com behind it. And you were just seeing like insane moves. Again, I was 6 at that time, or 5. So unfortunately, I wasn't investing yet.
Yeah, Brennan, you were.
I think Pat's got to like 400 million or something like that. But it honestly, there was companies out there that just got to crazy, silly valuations, and literally just had a website.
New normal.
At least there is. Well, not all the AI companies. I was going to say there's something behind, but some of the core companies there is for sure.
Mm-hmm.
And at the time there was, even in the internet boom, the core companies, the Amazons, there was something there as opposed to, pets.com. There's always these ancillary pieces.
Oh, you don't
of crap.
like pets?
It's my hatred of pets.
That's
No,
what I'm
I have several of them. So, all right. That's going to end our show for this week. Keep your questions coming into our Your Stock, Our Take segment. We'll endeavor to keep answering those. If you are watching this right now on YouTube, smash that subscribe button. If you are listening to this wherever you consume your podcasts, rate and review us. Now, as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.